Ladies and gentlemen, federal employees, welcome to today's episode. Today we're talking about, should you take a large lump sum out of your thrift savings plan or get a mortgage in retirement, whether that's keeping a mortgage you currently have, whether that's paying off your house early, whether it's buying a vacation home or retirement home. What is the best way to fund this sort of thing? And let me tell you this, if you do this wrong, you're going to spend tens of thousands of dollars in taxes that you didn't have to. And if you do it right, you'll be able to save a ton of money doing it the right way. Now, let me read the question that someone sent in. Now, if you are new here, welcome. Great to have you. My name is Dallin Hawes. I'm a financial planner that serves federal employees all day long and helps them retire comfortable and confident. And there's a link in the description below where federal employees just like you can submit questions that we field every week here on the show. So here's the question that someone submitted. And if you have a question yourself, go ahead and submit it below. Okay, this person asked, they say, with me being retired and 67 years old and having $400,000 in my TSP, would it be better to take out $300,000 out of the TSP to buy a $245,000 house by paying cash and only leaving $100,000 or so in the TSP, or is it better to get a mortgage at about 8% interest? So this is a phenomenally good question, and especially right now with high interest rates, this brings up a very good point and a situation where many of you are going to find yourselves in when you're trying to, let's say, move in retirement or whatever it is. Should you take a large lump sum out of your TSP for anything really, whether it's a house or a boat, or it doesn't matter. Should you take a big lump sum out of your TSP? What are the tax ramifications of that? And is there a better way? So to be honest, when it comes to this question, I really don't like either option. Option number one is they say, hey, should I take out the vast majority of my TSP all at once to pay for this house, not leaving me with very much in my thrift, or should I get an 8% mortgage, right? Both of those options don't sound very good at all. So my first question for whoever this is, for all of you, is do you really want that house? Is that a house that you could really afford? And I'm not saying it's not, I just don't know, because first of all, it's gonna leave you with not very much when it comes to your thrift savings plan. So I'd be very careful before making any decision getting into a property like this, where it's gonna really deplete things that you have. That's my first question. But the next question is, okay, let's say yes, you want to do it, you feel like you can afford to do it. The question that happens to be, what's the best way to do it? Should I take it from the thrift? Should I get a mortgage? How should I structure this? Now, that is a great question as well. And the interest rate is going to make a big difference. If your interest rate is relatively low, like it was a few years ago, like a 3-4%, it becomes a no-brainer. Go ahead and get the mortgage. You could pay it off early if you'd like, but the interest rate is so low, you might as well keep most of it in the TSP so you don't have to take it all out at once, which is a very painful thing for tax purposes, okay? But again, with high interest rates, which that's the environment we're in right now, the story and the strategy changes, where keeping an 8% mortgage for a relatively medium to long period of time is extremely painful. That hurts, okay? So here's the deal. Here are the principles I would think about. Number one, whenever we can help it, we do not ever want to take a large lump sum out of retirement accounts. That's IRAs, 403b, 401k, thrift savings plan. We almost never want to take large lump sums out because, as most of you know, most of your retirement money is probably going to be in the traditional TSP, a traditional IRA, meaning when that money comes out, that's taxable money. You have to pay taxes on it. And if you take it all out at once, like $300,000, for example, your tax bracket is going to skyrocket. You're going to be a very high tax bracket, probably higher than you've ever been or ever want to be. You're going to have to take a huge chunk of it and send it straight to the IRS, which is very painful. So principle number one is, whenever we can, let's say you do need a lot of money from your thrift, how can we spread it out? Can we spread that out over different tax years, right? Let's say you're planning to make the purchase in March. Well, can you take out some the previous December to spread it out amongst different tax years? That'd be strategy number one. How can you spread this out? Even if you need all the money, great, let's spread it out. Because just as an example, just doing the rough math, this federal employee says, hey, I'm going to take $300,000 out to be left with $245,000 to make the purchase. to be frank, if you take $300,000 out, your tax bracket's going to skyrocket. You're not going to be left with $245. You're going to be left with $220, depending on what other income you have, whether you're single or married. You could be left with even less, depending on your tax bracket, because it's going to pop you up where you're paying a large percentage of it straight in taxes. We don't want that. So if we can spread it out, then basically we could ideally keep you in some lower tax brackets, which means you save tens of thousands of dollars in tax money that you didn't have to pay, right? Just by structuring things the right way and spreading out the tax bill. So getting a mortgage in the short term can maybe be a key of spreading that out, spreading your thrift savings plan withdrawals out. For example, let's say you get the mortgage at 6, 7, 8%, whatever it is right now for you. But you come up with a plan and say, hey, look, I want to take, let's say, $50,000 out from my thrift over the next 5-6 years, so that by the end of the 5-6 years, I have the mortgage paid completely off, but I never had to take a huge amount from my thrift at any given tax year. That would be a strategy I would certainly look into, is how can you spread out those withdrawals, whether it's using a mortgage, whether starting early before you make the purchase. Let's say you're 65 and you want to make the purchase at 68. Okay, you've got a few years to spread out those withdrawals. And one thing I haven't even mentioned yet, this federal employee is 67 years old, which means they're probably on Medicare. And Medicare Part B is based on your income, meaning the more income you have, the higher the premiums are. If you take $300,000 out of your thrift, your Medicare premiums, once it comes around and they look at that income, is going to skyrocket. You're going to pay extra premiums, extra taxes. We don't want any of that for you. We want to spread it out to keep you in lower tax brackets and lower brackets for Medicare Part B whenever possible. So those are the principles. Again, I don't know. It depends on your interest rate. It depends how you're investing in your thrift to really tailor a plan for you. But those are the principles to keep in mind. Let's spread it out as best we can. I hate huge withdrawals if we can help it. I totally want you to live your retirement dream and spend your money how you want, but is there a way to structure it so you keep more of your money in your own pocket and sending less over to Uncle Sam in a completely legitimate, legal way? That is the goal. So I hope that's helpful. Again, if you have any questions that you want me to answer in a future episode, there's a link below to submit those, as well as there's tons of other resources that are, most of which are completely free for you as a federal employee to get the most out of your benefits and retire confident. I'll see you guys next time.